And what I'm going to go over today is the Federal Reserve and how do they affect the interest rates. First of all, the Federal Reserve is the banker's bank. It's a separate entity. It's about as federal as Federal Express, meaning it's not part of the United States government. It's kind of a cartel, so to speak, a financial cartel of the individual banks. Now, the Fed definitely controls the interest rates that Joe Sixpack like myself pay when they go to get a home. Now, there's three different types of rates. There's the discount rate, the federal funds rate, and the prime rate. The prime rate affects people like me at the lowest level. That's what the banks charge the consumers. The next one is the federal funds rate. That's what the banks charge each other. And that's what the Federal Reserve can control, those interest rates. Now, that's federal funds rate is going to be passed down to the prime rate. Now, the federal funds rate are what the banks borrow from each other. So, for instance, Wells Fargo has some sort of liquidity issue. They need to borrow some funds. They'll borrow it from Bank of America. They'll pay the federal funds rate. Now, the top one is the discount rate. That's a Fed discount window. That's when the banks really are in trouble and they have to borrow from the Federal Reserve. Like in 2008, 2009 financial crisis, the Fed discount rate, that lender of last resorts. That's what the banks have to go to, is the Federal Reserve, to fight some sort of really talk about monetary collapse. A lot of people are predicting that this could happen. A lot of these banks could be insolvent. I'm not going to get into this video. I'm just going to get a general overview. Now, that's monetary policy. The Federal Reserve affects the monetary policy by lowering and upping the interest rates, also increasing the reserve requirements that are required for the banks to hold on deposit. As compared to fiscal policy, that's more of Congress and the president can control fiscal policy and tax incentives. So, for instance, the fiscal policy tries to encourage people to buy homes through the mortgage deduction and other sort of incentives to buy a home and to make it worthwhile. Now, the Federal Reserve is very controversial. There's a great book called The Creature from Jekyll Island. I definitely recommend anyone reading it. It talks about the whole history dating back to the early 1900s. And the Federal Reserve definitely influences. Jerome Powell, when he speaks to people during his conferences, I know he had one last Wednesday, it affects the markets. Why? Well, they want to know what the money supply is going to be. That's usually the smart money is following this. Now, the federal funds rate is what controls and trickles down to the prime rate the consumers pay. This definitely has an influence on the housing market. This can create bubbles and also create slowdowns. Recessions can create depressions. What's the difference between a recession and a depression? Now, a recession is when your neighbor loses his job. Now, a depression is when you lose your job, and that is no fun. Well, what could be fun, if you please like and subscribe in the comment section below. Again, don't hate on me. I'm just a man with a mullet and a dream. Thanks a lot. Goodbye. Peace out.